At this time, let's begin today's NCMS Plan Employment Law webinar. What should employers expect under a Trump administration? It is my pleasure to introduce your first speaker today, Gary Bossert, Vice President of Operations with the NCMS Plan. Gary, you have the floor.
Great. Thank you, Jessica, and good morning to those who are attending. We really do appreciate you being part of this call today. I'll tell you how excited we are to have as many people register for this event, way more than we expected, quite frankly, but I think it's the topic that's really hot right now. So thank you all for being here. Again, today's topic is what should employers expect under a Trump administration? While we at the Medical Society Plan provide your practice with health insurance and related support, we know that you have to tackle many other difficult human resources issues in your practice every day. We have engaged with the law firm Nelson Mullins to bring you relevant and current information like today's topic to broaden our service to you. I am pleased to introduce our speaker today, Ann Murray. Ann is a partner in Nelson Mullins' Atlanta office where she practices in the areas of employee benefits and executive compensation. She is a member of her firm's healthcare team, which focuses on providing comprehensive services to hospitals, physician practices, and other healthcare providers, as well as others in the healthcare industry. She also previously served as in-house benefits counsel for a publicly traded company, which allows her to offer a more business-oriented and practical approach. Ann assists her clients with all types of HR and benefits-related matters, including those relating to qualified retirement plans, health and welfare benefits, including ERISA, ACA, and HIPAA compliance, equity incentives, deferred compensation, and other executive compensation arrangements, and payroll taxes, worker classification, and data protection. She obviously has her hands full. Ann is a regular speaker and writer on various topics, including the ACA, HIPAA, and data breaches, fiduciary compliance of investment committees, and on-site clinics. As Jessica mentioned, Ann will respond to questions at the end of the presentation, and you can type your questions into the Q&A window on your screen at any time during the presentation. So without further ado, let me welcome Ann and turn the floor over to her.
Thanks, Gary. And thanks, everyone, for attending today. Hopefully we can give you a little more insight into what we expect out of the Trump administration, at least, you know, what we've seen so far and what that indicates, you know, is likely to come. We're viewing this from the employer side. Obviously, there's a lot of laws that may be changing or may have, you know, modifications made to them over the coming months that are outside of the employer realm. But here, our focus today is going to be on your role as an employer and your interaction with your employees. We're going to talk about health plans and the ACA, worker misclassification or classification in general, Fair Labor Standards Act overtime regulations, some new sick leave mandates that have come out, fiduciary rule, Federal Defend Trade Secrets Act, and possible paid family leave laws that may be put into effect. Let's talk first about the Affordable Care Act. You're in an unusual position that not only are you affected as an employer by the Affordable Care Act, but in your business in general, you know, the Affordable Care Act has such a large impact. When we look at it from the employer side, just as a refresher, you know, how did we get here? Since 2010, when the Affordable Care Act went into place, we've seen a significant increase in the amount of coverage that you're required to provide through your employer-provided group health insurance. And you are now required to, if you're subject to the employer mandate, provide health coverage to all of your full-time employees and their children through age 26. Now, who's subject to the Affordable Care Act employer mandate? I mean, I think that's key. And for many of you, you know, you haven't hit that threshold yet. We look at the total number of full-time equivalents that you have. So in other words, the threshold is 50 full-time equivalents. We look at all of your full-time employees, those that you reasonably expect to work 30 or more hours per week. We count each of them as one, and then we take any part-time workers you have, we total up their hours, divide by 100 and I think it's 120 or 130, and that gives us full-time equivalents. That's what we use to determine whether you've hit the 50 full-time equivalent threshold to be subject to the Affordable Care Act. And what's really important here is when you're figuring out if you're subject to this employer mandate, you need to consider not only your practice or your organization, but any other related practice or organization. So if you are in a physician practice and you have a related surgery center or an investment in another, maybe it's a totally different business, not even related to the practice of medicine, if you have enough ownership or if there's shared management between those companies, you might be considered what we would call a controlled group or an affiliated service group. And that might mean that you need to be counting the employees of both of those related companies in figuring out if either one of them is subject to the Affordable Care Act's employer mandate. So that's an important takeaway for anyone who hasn't looked at that in the past. Consider businesses your spouse may own and that you might be involved in, or any other businesses that you have investments in, and make sure that you know whether or not you're supposed to be counting those. Because as we're going to talk about in a little while, this may be here for a while. So the penalty, in other words, the pain from the employer mandate for a lot of employers is that the penalty can really add up quickly. You have a choice to make as an employer. In order to comply with the employer mandate, you can either offer qualifying, affordable group health coverage to all of your full-time employees. And when we say all, they actually count 95% of your full-time employees as counting for all. Or you can choose to pay a penalty. And if you don't offer coverage to at least 95% of your full-time employees, your penalty is calculated by taking all of your full-time employees, multiplying it by 2,160, and that's your annual penalty. It's determined monthly, but it's easier, I think, for figuring out your costs to look at it from an annual perspective. That can add up quickly. So you really need to be focused on the bottom line here of what that might cost you if you choose not to offer affordable qualifying health coverage to 95% of your employees. Because if you offer to 94%, that means you violate the law, and even though you spent the money to offer coverage to 94% of your people, it still swoops back and calculates your penalty based on all of your full-time employees. So it can add up quickly. Even if you do offer coverage to 95% of your full-time employees, there's another way that the employer mandate can get you. And that's if your coverage is not rich enough or affordable. If it's not rich enough, meaning it doesn't provide enough coverage, or it's not affordable, then you can be subject to a penalty of $3,240 per year. That's the 2017 rate. For each employee who goes out to a state exchange and buys coverage there with a subsidy. So there's two different ways that you can become subject to the employer mandate. And a lot of employers had complained, hey, this, especially in industries with small profit margins, this is really costing us way too much. So one of the things that we all heard President Trump talk about on the campaign trail, and once he got into office, was to repeal and replace the employer mandate and the other Affordable Care Act provisions like the individual mandates, what has come to be known as Obamacare. So President Trump, after he took office, moved forward with this with this plan, and in February of 2017 announced his goals, which you'll see on the slide in front of you, were to protect access of persons with pre-existing conditions to the exchanges, using tax credits and HSAs, health savings accounts, to help people purchase coverage, giving more power to the states to expand Medicaid, limiting some liabilities of patients and doctors, and allowing health insurance sales across state lines. He then followed this up in early March, and we've all heard about this over the last month, with proposed legislation, and you'll see on the next couple of slides, that basically sought to repeal the individual mandate, that's the requirement that each individual go out and buy coverage, but also on the employer side, the proposed legislation said, okay, let's repeal the employer mandate penalties, take away some of the taxes that we're putting on people, including that extra Medicare tax on high wage earners that you have to add into your payroll system. They kept the Cadillac tax. They added some more broad health FSA rules, some special rules for small employers, but they didn't make any changes to your employer reporting, the content or coverage requirements within your plan, like that you cover dependents to age 26, or provide no-cost preventive care, don't place annual or lifetime limits on your essential health benefits. They were not able to address any of those because the way that the Trump administration was trying to achieve this repeal of Obamacare, or the ACA, was to approach it through reconciliation, which meant they had to tie everything to being some sort of budgetary or cost item for the federal government. So they really couldn't attack some of these provisions of the ACA. But, as we all know, despite having started this process earlier this month, they really couldn't pull together any Democratic support, and they had difficulties getting agreement among the Republicans. So, as a result, as of last Friday, the House vote was canceled. And what we're hearing from those that are working with the Trump administration is that there's no repeal in the foreseeable future. So where does that leave you as an employer? Hopefully you've continued to comply with the Affordable Care Act employer mandate requirements. Those have remained in effect. It is the law. There are current, what we would call non-enforcement executive orders that have been put out by the Trump administration, where they say and have ordered the various departments to not enforce certain taxes and rules. We don't know how much longer that will stay in place. I mean, many experts say this can't go on forever when the law is in effect. And if you want to rely on those non-enforcement orders that have been issued, I think that it really puts you at risk because there's still a legal requirement. And down the road, we could see some sort of retroactive application of these rules, meaning that they may swing back around and say, listen, yeah, we weren't enforcing it before, but you still have a violation, and we're going to enforce it now. So I think that you have to take a lot of these risks into account. The best approach is to continue to comply with the legal requirements. Review your compliance efforts to date. Since we're not seeing these rules go away anytime soon, you're going to want to, as you move into the planning season for 2018, talk with your broker and with others about things that you can do. Certainly Gary and his folks are always on the lookout for making their plan work more efficiently, and the combined plan is certainly one great way for employers to help reduce their health costs and share some of those risks. But you just want to keep your eyes open for when new efforts are made to change or repeal some of these rules. I think we're not going to see a wholesale effort to get rid of the Affordable Care Act employer mandate anytime soon, you know, based on what the Trump administration has now said, that there's nothing in the foreseeable future, but also, you know, the fact that they're not able to get the support. But at the same time, they may still make some efforts to try to change or repeal certain small requirements. And so you're going to want to continue to monitor what happens, because if you can take advantage of certain of these rules, you know, maybe they'll step back and change something like the definition of full-time employee. That was a provision that got a lot of people upset because 30 hours per week was not considered by many employers to be full-time, and they felt like this really put a lot more burden on them. So that may be another way that they decide to attack it. On the next couple of slides, as part of your overall review to make sure you are in compliance, let's just remind ourselves of what are the rules. As I said at the beginning, make sure you know whether or not you're an applicable large employer. Once again, 50 or more full-time equivalents. If you looked at this back a couple years ago when the employer mandate went into effect and got comfortable, I'm below the threshold, you know, just make sure, hey, hopefully businesses can continue to grow. But especially if you've entered into any sorts of acquisitions or joint ventures, if you did any type of roll-up with a, you know, hospital organization, make sure you know whether or not you have to count all those other organizations as some sort of related entity. And remember, you've got to offer coverage to 95% of your full-time employees and their children up to age 26. Full-time employee is still 30 or more hours per week. You know, look back, one of the often overlooked areas is look back at your employee handbook and make sure that you've updated some of the provisions in your employee handbook to indicate that you now treat full-time employees as those that are 30 or more hours per week. And remember, you don't have to do this across the board. I mean, full-time for purposes of the health plan can be different than what you treat as full-time for purposes of your vacation or PTO or providing life or disability coverage. You know, you can certainly separate people out and have different categories by benefit. You just need to be clear in what you're communicating in your handbook or your policies. And remember, to be affordable, employee premiums can't exceed 9.69% of the employee's taxable wages. Most employers are using box 1 to determine, they basically just take 9.69% of what someone is expected for the coming year to earn as their box 1 wages, and that's where they set their threshold. But if in your payroll system, back in 2000, let's say 15, you built this into your payroll system, you may have used 9.5% because that's what the limit was back then. Each year there's a cost of living adjustment, and so for 2017 we're now at 9.69%. So it's a good time to just make sure that what you've sort of baked into your payroll system is getting updated. As I said, depending on the level of non-compliance, whether you chose not to offer coverage to everyone or if you're just offering sort of lesser or non-affordable coverage, make sure that you're taking into account what are the new penalty numbers. And then remember, in fact, tomorrow is the deadline, if you file electronically, to get your Form 1095 packages filed with the IRS. Those employer reporting requirements are still out there. And once again, these apply to anyone who has 50 or more full-time employees. So you need to, full-time equivalents. So in other words, are you or aren't you an applicable large employer that's subject to the employer mandate? If you are, then you need to be filing your IRS Form 1094 and 1095. And if it's electronically, that is tomorrow. Most of you are aware, and these have not been touched at all in the proposed legislation, but your waiting period can't exceed 90 days. and your coverage still has to satisfy all of those content requirements we talked about. So that's where we are on the Affordable Care Act. End result, there's no changes. Now's just a good time to make sure that, I've talked to a couple of clients of mine where they've called and said, well, I was talking to managers in a couple of our locations, and they've quit worrying about keeping people's part-time schedules below 30 hours because the ACA is going to get repealed. And so they said, or it's not being enforced, so they said they don't have to worry about it. That's, as I told these clients, that's risky. You definitely want to make sure that if you have multiple locations, or if you have different people who are supervising groups of part-time employees, that they know, we're still operating where we want to keep people who are part-time below that 30-hour per week threshold. Just make sure everyone's on the same page. Okay, now let's talk about worker misclassification. You've heard for years that worker misclassification is an issue for both the federal and state government. I mean, it's always been something that's talked about, but we continue to see a lot of problems with how employers are classifying their workers. With so many more people working remote and working at multiple locations, traveling a lot more, there tends to be among some employers an urge to give those employees 1099 status and to push all of the responsibilities onto those employees. I mean, it's also in part because a lot of employers are looking at these Affordable Care Act mandates and saying, well, if it's not my employee, I don't have to offer them coverage, so let's just make them an independent contractor. Well, the EEOC and the Department of Labor and a lot of states have really started focusing on this. I mean, earlier this year, the EEOC said that independent contractor issues are going to be a priority in its strategic enforcement plan. The Obama Department of Labor back in 2011 and 35 states, now not North Carolina, note, but 35 states have signed memorandums of understanding that misclassification is an initiative, a focus for them. And we're seeing a lot more focus from the IRS. Actually, I just finished a case on that, on misclassification. The IRS is taking a much more hardline stance on how classification is being handled. So we don't know at this point how the Trump administration's appointees are going to come out on this issue, but it's not just about the federal government. As I said, we're seeing so many states focus on misclassification, and we're seeing so many different agencies that I think you can expect a continued emphasis on making sure that workers are being properly classified. And so look at, if you use a number of 1099 employees or independent contractors in your business, step back and talk to whoever is making that decision. And if it's you, step back and think about how are you making this decision on whether or not someone is going to be an independent contractor or an employee. It's an important decision, and there's a lot of money at stake because, especially with the Affordable Care Act staying in place, if you get it wrong, then you have not, or you've failed to withhold income taxes, Social Security and Medicare taxes, unemployment taxes, workers' comp premiums. There could be civil actions for minimum wages or overtime, sick pay, and family medical leave. But significantly, what can happen is if you are an applicable large employer, so if you are one of those businesses that might be subject to the Affordable Care Act's employer mandate, if you use a number of 1099 independent contractors that really should have been employees, and if they get recharacterized, and maybe this, let's say, here's an example, let's say you have 30 full-time employees. You're not subject to the ACA employer mandate. You're not worrying about it. You maybe went out and got a water during the first part of the presentation because it didn't apply to you. But let's say you use 15 independent contractors for certain areas in your business. And now the IRS comes in and says, you know, I really think these people are employees. And they go back and recharacterize these people as employees. Well, now you've got a problem because now you didn't think you were subject to the Affordable Care Act employer mandate, but now you are, because now you have, I think on my numbers, because I've already forgotten, now you've got, I was intending to be at a 55 full-time employee number. If I got the math wrong, I apologize, but let's say that throws you over the 50 full-time equivalent threshold. Now, all of a sudden, you didn't offer coverage to everyone, and we swoop back and calculate a penalty that's going to be 6 figures per year, and it's going to be retroactive back to the time that those people came on with you. So you can see where this can really add up. I mean, we've also got anti-discrimination, OSHA, a lot of other areas. But it's definitely an area where if you've never focused on it before or you don't have some set process in place, make sure that you do and work with whoever your outside advisors are. There's ways that if you think that you haven't been doing it right, there's ways that you can actually kind of self-report and avoid any significant penalties. If you're looking to be acquired, it's definitely a hot issue for merger and acquisition buyers these days. We've seen so many, in fact, also reps and warranties insurers that are out there in the acquisition world will refuse to cover worker misclassification issues in a lot of deals. It's a hot area. I don't think with the push from the Trump administration, we'll see what happens with their various appointees, but especially given the Trump administration statement that they want to push more powers to the states, I think that you're going to see more state attorney generals get very involved in this misclassification. And even though North Carolina didn't sign on to the MOU that I talked about earlier, I think that it's still something that almost every attorney general is looking at in one way, shape, or form. Okay, next topic that we're going to discuss is going to be the Fair Labor Standards Act overtime regulations. We all expected these to go into effect on December 1st of 2016. And frankly, it came as quite a surprise for a lot of people when, at the last minute, just before Thanksgiving, a Texas federal court issued a preliminary injunction and basically enjoined this from going into effect. So why are we focused on the FLSA overtime, the new rules? Well, the FLSA basically says if you're exempt, then which would be certain salaried employees who you don't have to comply with the overtime provisions with respect to them. Then, this gives you a lot more flexibility. If someone is non-exempt, then they have to receive a minimum wage and be paid time and a half for all hours in excess of 40 in a given week. Now, the new rules that were scheduled to go into effect on December 1st of 2016 were, frankly, it was the first time in a long time that anyone was making changes to the overtime rules. And it wasn't, the new rules weren't making a change to how we defined the different classes of non-exempt employees, the different classes of exempt employees. In other words, it wasn't changing the administrative exemption or the executive exemption. What it was doing was the new rules were increasing the threshold. In fact, doubling the threshold for the salary that someone needed to earn in order to satisfy an exemption. It was going to go from $23,455 to $47,476. And for a lot of you, that took a good portion of your, especially administrative or office personnel. And then that number was also set to increase every 3 years. In addition, the rules were supposed to increase the total annual compensation that was needed to exempt highly compensated employees from $100,000 to $134,000. It allowed employers to take a credit for up to 10% of bonuses, commissions, or other incentives and count those towards these minimum salary thresholds that we're talking about. And then it also, like I said, established a automatic increase to some of these levels. So in the future, we wouldn't have these big periods of time before the numbers went up. So the Texas case is currently on appeal. So it's on appeal to the Fifth Circuit. And originally, the Department of Justice was supposed to reply and file its brief by January 31st. This got extended to March, and subsequently now has been extended to May 1st. We don't know what the Department of Justice is going to do. Many believe that the Trump administration, while it sits back and sort of reevaluates what it wants to do with the appeal, that it may just choose not to file a brief, may choose to just let the case stand, and maybe down the road initiate some sort of rulemaking that will get rid of these changes. The expectation among experts is that these new overtime rules are never going to go into effect, at least not as part of this big comprehensive package that was supposed to have taken effect in December. So what does that mean for you if you've already taken steps to comply with the rules? For a lot of people, they made changes to increase their employees' pay levels in order to continue to exempt them from the overtime rules. And I think what's difficult there is that if you've already taken these steps to increase someone's pay, as I've heard from a lot of clients, it's hard to go back and say to that employee, oh, oops, I'm no longer required to pay you more, so, you'll see your next paycheck go down. So what I'm seeing for a lot of employers is where they, were good plan-ahead people and they already put some of these changes into effect, they're sort of stuck with them. To the extent that you put in place new policies or procedures that would have required more of your workforce above that 23,000 level to track their hours, you could back off of that and just, I wouldn't get rid of it altogether. Have it ready to go if we're wrong here and they end up finding that the rule will stay in place. But you certainly don't need to continue to comply with those documentation requirements or administrative requirements, and you could back off of those. Our next topic is sick leave mandate. This is an interesting area, and this is the employers that I want to focus on this are going to be those of you who have operations in multiple locations. So far, we have not seen North Carolina cities adopt any new sick leave mandates, but there's always tomorrow. But there is a increasing tendency among all sorts of states and cities to put in place new sick leave laws. And for instance, we're seeing, and you'll see just on the slide in front of you that, we've got Washington, D.C., we've got all sorts of cities in New Jersey, Philadelphia has a rule. if you are in, and especially a lot of the West Coast cities, if you're in any of these locations or you have other businesses that are related to you or some of your operations that cross state lines, you need to be focused on some of these sick leave rules, because all of these rules have different sick leave requirements. They define people differently. I mean, there's a couple of these cities that have put in place rules that say, for example, if anyone who you think of like family becomes sick, you can take time off to take care of them. So they don't actually have to be a family member, and I can see where this would make sense in certain limited cases. But, you know, if the guy down the street is not your family member, but, you know, you've grown up with him, you've always thought of Bob as, you know, another father figure, well, now your employer has to give you time off to take care of Bob. You know, in some of these locations, it can be very difficult for employers to try to administer these rules. And what makes it worse is trying to come up with one policy, one-size-fits-all type of administration or policy is very difficult. So if you have operations in multiple locations, make sure that you are tracking, or that your payroll provider or record keeper, whoever you're working with on the payroll side, is keeping you up to date on what the different sick leave rules are. And if you hear about something, and certainly, you know, we try to keep people updated, but if you hear of something going into place in any city, county, or state in North Carolina, you know, you're going to want to pay attention, because we expect to see these rules continue to grow and continue to be issued. If you asked me 5 years ago how many of these rules were out there, there were, you know, less than half a dozen. Now our tracking spreadsheet has 36 locations that have put in place their own sick leave rules. There's even one location that gives you time off if your pet is sick, which is interesting and a lot harder to administer for an employer. So stay tuned. If it does apply to you, you know, work with someone on the outside to make sure that you've put in place some sort of global policy that kind of tries to make it easier to administer. Many of you may have heard about the fiduciary rule. This is the ERISA, Employer Retirement Income Security Act rule, that was set to take place in April of this year. The fiduciary rule's goal was to basically create more fiduciary duties among investment professionals, financial professionals, and other retirement plan advisors. Because historically, if you had, let's say, an IRA, or with your practice, if you sponsor SEP IRAs for your employees, the investment professional that you work with, or the financial consultant, wasn't a fiduciary, didn't really owe any duties with respect to the SEP IRA or the IRA. And so they were able to charge commissions or revenue sharing or other indirect compensation that maybe somebody who normally worked with a 401k plan wouldn't have been able to do. And there was a lot of, you know, it's always the few that ruin it for everybody else, but there were a lot of complaints, and there were some people that were out there with a lot more hidden fees that the federal government felt was unfair and needed to change. So that is the impetus behind these rules. Many of you may have received materials and amendments from your outside retirement plan providers. For instance, Fidelity has sent out amendments to its service agreements already. You know, I think you'll see this, Wells Fargo did the same. Many other providers have, you may have gotten something in the mail that sort of seemed like blah, 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 gobbledygook, but this is what it was intended to take care of, was to create more transparency with fees, and to, in most cases for a Fidelity or a Wells Fargo, to try to fit some of their services within exceptions from these rules. The Trump administration is not a fan of these rules. You know, they've heard from a lot of these investment providers that they're too burdensome, that it doesn't really create the protections that it should have, and so they have actually delayed these rules for 60 days. Will they be further delayed? We don't know. The expectation among most experts is that we will see another delay and maybe an eventual repeal of these rules. If you've already had a provider that's contacted you about these rules and maybe made some changes, what we're hearing is that, you know, the Fidelities and Wells Fargos of the world, I'm not speaking for them specifically, but some of these larger institutions have said, listen, we've already changed all our processes and put things in place. We're not changing back. So they kind of are what they are. So you may hear nothing more on this. But on the flip side, if this actually does go into effect, you may find that you're going to get a rash of a flood of communications from your outside providers that says, ooh, there's a new fiduciary rule and we need to change this or we need to amend this. Just know if that happens, sort of, this is what the background is. And it's not something that poses a big risk to you as a sponsor of a retirement plan. In the end, what it really does is provides more protections. The Defend Trade Secrets Act. This is another law that has been on the books for a while, was passed back in May of 2016, and we thought that this might be another item that the Trump administration would, you know, target and try to take away the rules or stop them before they took effect. But surprisingly enough, they actually did not. The Defend Trade Secrets Act basically authorizes a federal private right of action for companies and individuals for trade secret misappropriation. And it seeks to standardize some of the remedies that are available. It used to be that you had to rely on different state laws to protect your trade secrets. But the Defend Trade Secrets Act, in addition to granting access to the federal courts, it creates what many think is a powerful tool, the civil seizure order. So it helps companies and individuals who have trade secrets prevent theft. Now, as with many of these rules, some of you as employers, trade secrets are not a concern whatsoever. But if you do any type of research or development, this may be something that is of great importance to your business. What's important for you to know is that this has taken effect. It's currently the law. If you don't want to take advantage of it, there's nothing you need to do. But if you actually do have trade secrets, like I said, research and development, you've got some sort of product, you've got, you know, trade secret information that you want to protect, then you're going to want to make sure that you've taken steps to get the protections. For instance, the Defend Trade Secrets Act includes this whistleblower protection provision that requires employers to actually provide a written notice to the employees of the whistleblower immunity provision. So you have to put a written notice in any kind of contract or agreement that you have with your employee that governs the use of trade secrets. So if you have confidentiality agreements, maybe as part of a non-compete or non-solicitation agreement, you have some sort of confidentiality provision. You're going to want to include the Defend Trade Secrets Act language in those agreements. I mean, you may have to go and amend them, but the advantage is if you do this, you're actually going to be able to go to federal court and have a broader enforcement of your trade secrets protections. If you don't comply, then you're limited to what the particular state offers you, and if somebody has gone out of state, it can become much more difficult to enforce the protection of your trade secrets. So for those of you where that might be an important element, we do not expect the Trump administration to do anything to take away the Defend Trade Secrets Act. We think that this will remain in effect, and also if you have any sort of provision in your handbook, sometimes handbooks will have confidentiality provisions, and as an employer you may take the view that when someone signs off on the handbook that is agreeing to these confidentiality requirements. If so, make sure that you update your handbook as well. And our final item is paid family leave. This is more of just a heads up that this may be on the horizon. The Trump administration, when it made its announcements back in February of 2017, among other things, when it announced all of the Affordable Care Act goals that it had for repealing and replacing, President Trump also announced that paid family leave was on his agenda. We haven't heard much more discussion. Admittedly, there's been a few other things out there that the press is focused on as well as the administration. But he did say that this is on his agenda to be addressed. What he wanted was, our understanding is to have a much more fulsome federal paid family leave requirement. So timing's unclear. Maybe he'll be able to focus on it, maybe not. It's also unclear whether or not there'd be enough support from, as we've all now seen, there may not be enough support within the Republican Party to push many of these things through, especially if the far right is not bought into whatever the proposed rule might be. So stay tuned. Those are the main focuses we're seeing from the administration so far. There aren't any other real employer-related subjects. Other than, income tax reform, but that just applies to businesses in general. We're not seeing anything else on the horizon. There is an executive order that came out, early in President Trump's administration of non-enforcement, and I touched on this earlier. I think that non-enforcement is certainly for employers who are not in favor of some of these rules, it's easy to find yourself focused on the fact that, well, President Trump has directed the different agencies to, not to enforce taxes and penalties, but that can be revoked at any time. And if you've fallen so out of compliance that you can't really, in a sense, get back on the horse, it could be difficult. And I think that that's a dangerous approach to take. With that, I think that we will open this up to any questions if they have them. Gary?
Great, thanks, Ann. I do have a question here. The question goes back to the discussion on the Affordable Care Act. The question is this: when the employer offers health benefits to the employee with an option to enroll children, is the affordable requirement of less than 9.69% of taxable wages applicable to the monthly premium for the children as well as the employee?
Very good question. No. In fact, the affordability requirement only applies to the cost of the employee-only coverage. So if you offer, let's say, spousal coverage, first off, you're not required to offer spousal coverage. There's a big trend where a lot of employers have started, when I say a lot, a growing number, I'm not saying the vast majority, have chosen to either exclude spousal coverage where the spouse has coverage through another employer, or to charge 100% of the extra cost for the spouse, to the employee. You can do the same with children, passing along 100% of the child's cost. You can't exclude a child who has coverage elsewhere, but you could pass along more of the cost. In the end, the only place where you need to be focused on that affordability, the 9.69%, is when it comes to the cost of employee-only coverage.
And let me build on that question also, because many of our practices have more than one plan that they offer to their employees as a choice of health insurance. So how would they calculate that 9.69% if they're offering more than one plan option to their employees?
So the requirement is that you must offer at least one affordable qualifying coverage to each employee. So if someone has chosen more than one of your coverage options, if the employer's chosen to offer, you know, the high PPO and low PPO and maybe a consumer-driven plan, one of those choices has to satisfy these affordability requirements as to each employee. So it might be that, you know, you've chosen to offer management the high PPO plan and maybe everybody else, you know, two different choices. You don't have to offer the same thing to every employee. It's just every employee has to have access to at least one coverage offering that is affordable.
And here's another question that, again, goes back to potential replacements to ACA. You mentioned HSAs. So the question, I think, has to do with the fact that many of our practices offer high-deductible health plans with HSAs, and I know that we have significant enrollment in that plan type. If you could get a little bit more specific about what the likely or proposed changes to HSAs were discussed during that repeal-replace debate.
Yes. So health savings accounts, this was a big focus of the Paul Ryan plan, and was also a big focus of the Trump administration's proposed legislation, the one that was just shot down last Friday. We expect what the Trump administration had proposed was that they wanted to increase the limits on health savings accounts so they better match. There's kind of a disconnect right now between health savings account limits and high deductible health plan limits. They wanted to increase the HSA limits so that they better lined up with high deductible health plans. They also wanted to, for those of you that have had flexible spending accounts or HSA for a number of years, if you remember, kind of prior to the Affordable Care Act coming into play, you used to be able to, sort of for a limited window, you used to be able to reimburse over-the-counter medicines. Remember that? That is something that the Trump administration wanted to put back in place, and so they had broadened the types of benefits that health savings accounts could reimburse to include the over-the-counter medications. And they also broadened the types of expenses that health savings accounts could reimburse so that there were look-backs. In other words, sometimes, as many of you may find, sometimes it takes a while for an employee to get around to opening their health savings account. Or sometimes an employee may sign up for coverage you know, within their first 30 days of employment that maybe retroactively goes back and covers them. But the way the HSA rules work, you can't go back and cover an expense that was incurred prior to the date your HSA was set up. That's the first date that you actually put money, or a penny, a dollar, whatever it might be, into the HSA. So one of the things that they were trying to do was fix that problem and allow as much as a 60-day look back within HSAs. And then finally, they were also had put in place a provision within HSAs that would allow catch-up contributions to be made to HSAs. Now, I think that you could still see some of those efforts to broaden the use of HSAs come in later this year or early next year. Obviously, only time will tell, but those seem to be the types of changes that were not as controversial with the two parties.
Great, thank you. And I think we have time for just one more question. This one has to do with mergers and acquisitions. So how does the timing of an acquisition or an opening of a new office during the year affect a practice's ALE status as an applicable large employer? At what point does that growth then impact their qualification as an ALE in the future? Does that make sense?
Oh, yeah, that's a tricky question. And you know, we go round and round about this on all of our acquisitions these days. there's a couple, I think, very set rules that you need to focus on. If one of the two entities is an applicable large employer, from what we've seen with interpretation of the Affordable Care Act so far, you know, let's say that you're a practice group that has more than 50 full-time equivalents. So you're already an ALE, and you acquire a smaller practice group, or, you know, a couple new physicians come in. When you close that deal, there is a reasonable argument that everybody, including that acquired group, is suddenly subject to the Affordable Care Act employer mandate, and the time is running on the penalties. So you really need to focus on that when you're doing diligence in these deals, because it could be immediate. Now, if we have two practices that are both small employers, meaning they never qualified as ALEs, and now they come together and create a larger practice, there, honestly, we have a bit of a gray area. You know, the rule is that you look back to the prior year and whether or not you had a sufficient number of full-time equivalents, whether you were 50 or more in the prior year, in order to trigger ALE status. It's not clear from the guidance whether or not we can really separate out those two entities, or whether, when we look back, whether we would have to treat them as combined. Conservative employers would take the view, hey, when we close this deal, we need to make sure that we've got coverage in place and that, you know, that we're all compliant for the good of all. You know, some will take a more aggressive approach, and, you know, we don't know. Maybe you'll get lucky and non-enforcement will be, you know, your best friend, you know, and maybe they'll come out with more guidance. But at this point, that's where we still have a gray area in the M&A world.
Great. Thank you, Ann. Well, that concludes today's webinar. Ann, I want to thank you so much for taking your time to spend with us and share this great information. For those who attended, you may have noticed a file transfer pop-up window on your desktop. You can download a copy of Ann's presentation by clicking on download and have a PDF of the handouts. And for, again, those who attended, we plan to have a number of these webinars this year, continue this series, so please watch for an invitation. Most likely the next one will be scheduled for June or July, and we hope to see you again then. Thank you so much. Have a good afternoon.